Hello everyone. So in this video I'd like to share some thoughts around things to think about if you've got a large exposure to one particular company, and specifically what I'm thinking of is if that company is your employer. So this happens on a really regular basis, especially where you've got senior or key members of staff in an organisation. Often part of the remuneration package is shares as well as cash. And those shares can be, sometimes they're deliverable now, so you can sell them and do what you want with them as soon as you receive them. But in the majority of cases, they come with some form of lock-in, so 1, 3 or even 5 years, are not unusual. And it's a really popular way for companies to attract, reward, and then to retain key members of staff. But what I'm going to answer in this video is from a personal investment point of view. What are the things that you should think about if this situation affects you? So I've helped clients with this on a number of different occasions and across a number of different sectors. So the idea here is just to sum together the benefit of some of that experience. So I thought I'd run through a few factors for you to think about. So number one is that you may know your part of the company really well, but you don't know everything. So there's risk in this sort of unknown. So bear in mind, if you're working for or even running one division or department or whatever it may be, it's probably fair to say that you know that department inside out. But when you've got shares in the company, that's a share of everything, every department. So there is a certain inherent risk there. So what are other departments doing or not doing? New product launches, the financing of the business, the debt structure of the business, the macro environment that the business is operating in. All of those are real key factors to inputs into the share price, and they're not necessarily things that you're going to be completely well versed on. So vital to bear that in mind. So the next point that I would make is that markets can change, and they can change really quite quickly. So we've seen it numerous times in the past where certain companies or even sectors can all of a sudden become quite flavour of the month. They become what's called a stock market darling. So the stock market really likes them and values them highly for one reason or another, which is great. And that can be very, very beneficial to share prices. But that can go as quickly as it can arrive, insofar as if the prospects change or the market's view of that company changes, then actually that sort of premium valuation can evaporate quite quickly. And that can happen without any real fundamental change to the business's day-to-day financial performance. So something to be really aware of is how your company is positioned in the stock market and where it could be positioned in the future. So the next point I'd make is around your own long-term goals and how these shares fit in with that. So this is a much more personal view. So for example, if you're invested and you work for a very high-tech, high-growth company, and you want stability of capital, so let's say you're coming towards the end of your career, or you want a career break and you want to turn that fixed asset into an income stream, are those two compatible? Is your investment compatible with your need, your desire to turn this money into an income stream, or whatever it may be? Or look at it the other way around. If you want adventurous growth and you're working for a large, very stable, low return, mature business, is that compatible? Is that a good allocation of your own capital? So it's something to think about. So another point I'd make is around being really clear on what is known as your book cost or your acquisition cost for the shares. So that's from a UK perspective, that's working out your capital gains tax position, and in particular understanding the effect of selling those shares if you wanted to, and also when you can sell those shares without any restrictions. And that, to find out more about that, that's something that would come from your own company. So HR, payroll, or reward department can help you establish that. And then finally, just a special note around shares in the company that you work for once you've retired. So this is worth really spending a few moments on. And that's the company that you worked for can be very different from the company that you retired from. So, it's very easy once you've been retired and out of a business for 2, 3, 5, 10 years, actually the business that you're invested in can look very different to what it was when the business you were working in. and also when you were shaping that company's future. So when you're not seeing it from the inside every day, there can be a lot of drift. So I'd just be very conscious of that, and keep yourself up to speed with exactly what the company is doing and where it's going, and take an objective view of it. And again, passing those same tests. Is it doing what I want it to do, and is it helping me? The emotional attachment of having shares for a long time can be great, but it can also be a very dangerous thing. It can sometimes make investors quite blinkered to what's going on in a business. So there you go. So I hope that these insights have been really useful. And as always, please do like, comment and share if you found this helpful. Thank you.